Good morning and welcome to the Saxo Bank Morning Call. This is Wednesday, September 19th, and we had quite a session overnight. Certainly in equities, the Asian markets really set on fire. And ironically, all this happening with the big story and the big headlines about the latest escalation in trade wars. So what happened in Asia, Peter?
Well, we had another massive session in China, with Chinese equities up 2% in the mainland, almost 2% in Hong Kong, and that's an extension of the already existing 2% move we had yesterday. So we're now off 4% from the lows, and we're pushing into new territory. We're getting very close to that 3,400 level in the CSI 300 index futures. I think the big question here is, if you bring up the chart, you can probably see what I'm talking about here. So we're pushing towards that resistance level at the 3,400 level, as I just spoke about. The big question here is, can we push through that, and have we really turned a corner in China? My thinking is still that we have the rising interest rates around the world, particularly in US dollars, and we still have a strong dollar. We have the tariffs. I think that's still unbalanced. I think there could be more weakness coming both to China but the emerging markets overall. But I'll talk about that in a few minutes.
Yeah, I agree, and I think that is the big question. We have yields on the move here. Finally, we're seeing that move with the 10-year crossing above 3%. In fact, 3.05% was the close on the 10-year. I have a chart here just to give an indication on where we are. I mean, this 3% level, we've been obsessing about it for a long time, all the way since back in the early this year. We didn't quite get there. Early this year, we crossed above in May, and now we're back above here now. And the question is, how far and how aggressively does this extend? And at what point, as you mentioned, Peter, this eventually, these long yields going higher is always a classic, a massive resistance to equity prices. But is that now, or is that at is that at 3.5%, or is it not till 4%? These are the questions we don't know the answers to yet.
Exactly, but you know that as well. The 4.5-4% in nominal interest rate, long end of the yield curve, has been put out there as sort of the magical number based on historical relationships. I think because of the debt saturation that we have in society, I think the inflection point is much lower.
The ceiling is lower.
Yeah, the ceiling is lower. I think it's much closer to 3.5 than the 4.5.
Right. Okay. So, and then if we look at the next chart, which I have of the Bund yield, to talk about low ceilings, of course, those German Bund yields have been very low, below 1% for the longest time. But this 0.5% level, this is a weekly chart, so a little bit of a longer time frame here. But we're not just seeing U.S. yields on the move is the main message here. If you look even out to the Euribor curve, trying to price in when the ECB finally moves on interest rates, we're starting to finally see some action looking out into the 2020 contracts on Euribor, seeing a bit of rate hikes priced into that. So I think as long as we're seeing the spreads relatively close and not widening dramatically in favor of the U.S. dollar, this challenges the U.S. dollar hegemony. And the latest the currency I've seen on the move here, and I have a chart here, is on dollar CAD. We mentioned the Aussie dollar in my chart video yesterday, and Aussie yen. The yen does terrible when yields are rising, but as well, the dollar not doing so great against the more risk-on currencies in this combination of higher yields and risk appetite managing to do okay despite that. We're below the 130 level here. The big test for dollar Canada into the end of the week is going to be that Canadian CPI number, which I think you need to see the 2-year spread coming back in favor of Canada a bit to see a significant break below that 200-day moving average. And my next chart, speaking of interest rates in Europe and the spreads to Japan, is on Euro-Yen, where we're seeing a Euro-Yen on the rise, hitting into some big resistance levels. The 200-day moving average, we've essentially crossed above that this morning. There's some minor chart points above that, but looking like it's on the move as well. And again, I think as long as these yields are rising, it's most negative for the Japanese yen. Another Bank of Japan meeting overnight, not seeing any change to policy. They're in wait-and-see mode, and this tends to favor yen weakness. Combination of higher yields and risk appetite doing quite well, actually, across global markets. And I think it's also, we talked about emerging markets, Peter. I think it's a positive for emerging markets at the moment. I think I agree. Once if these yields persist in rising, eventually there's a train wreck there for and resistance to emerging market rallies. But for the moment, it seems to be quite supportive.
Yeah, I think that in the short term, there's definitely a sort of a bandwagon to jump on here for equity traders, and that will sort of be the tactical play. But I brought you a chart with us. We never shy of admitting our faults. So back in, I think it was early August, when we already had a lot of damage in the emerging markets, we came out with a call to go positive or long emerging markets and then hedge it against U.S. equities that were quite elevated in terms of valuations. And we came back all the way almost to zero in terms of return. And then We went below that 5% that we had put in as a stop loss. So basically our trade idea is not valid any longer. But it's just to say that we were pretty early on the emerging markets. I think there is a trade here still in emerging markets, short term, as you say. But I think we're moving into this final phase where you eventually, I think the high interest rate will really begin to have some. And
if we look back classically, talk about high interest rates, you see the yield curve also starting to steepen. You talk about cyclically the flattening to inverted yield curve is the so-called recession warning, but it's actually with a very significant delay. And it's actually when the yield curve starts to persistently steepening, that's the last phase into the actual recession that then unfolds. Although it's often because the short end starts to come lower, not necessarily because the long end goes higher. But nonetheless, it's an interesting development. I think these interest rates moves are the biggest question right here for markets. The duration of the move and when we need to start worrying about it. But your last chart of the day, people apparently getting high on pot stocks or marijuana stocks, whatever we want to call them.
Exactly. So this is an index that's tracking the largest cannabis stocks in the North American market. So companies publicly listed in Canada and in the US. And you can see here we've had a big move, and we had an IPO of Tilray a couple of weeks ago, and we're basically up almost 50% in only 1 month's time. I've been saying basically since January, February, not only to media here in Denmark, but also media elsewhere, that I think it's completely overvalued. And we talked about both this morning, but also yesterday. It's a very simple commodity. It's very easy to grow cannabis. So if you just look at other grains and soft commodities, it's typically you don't have an industry where you can set the price. It's you just have to accept the price in the market. And I think this industry will be the same. I think it's very, very difficult to create a competitive advantage. I know Cannabis Growth is really trying to swell their market share, probably to not corner, but really control a bigger part of the market. But I still think eventually it will be difficult. It just gives us some color here. Cannabis Growth, just as an example, it's nothing to do with a trade recommendation or anything, but 15 billion Canadian dollars is the enterprise value. The last 12 months, they did 88 million in sales in Canadian dollars. I've never seen anything like it.
Price to sales is completely ridiculous.
It's .com twice two, basically.
Okay.
Yeah.
Very interesting. I just wanted to round out actually today with some thoughts on the most interesting thing I think is going on in markets, and that is we saw these trade headlines, big trade war confrontation. We've seen China retaliating, and the U.S. saying they were going to retaliate in terms with even more tariffs if the Chinese did retaliate. But nonetheless, we have markets in a very positive mood. Why is this? I think it's the big question that is demanded of traders right here. And I'm not sure I have the answers, but I think a couple things come to mind. We have the fact that the Chinese didn't respond with a very aggressive tariff. It's only a 5 to 10% tariff level. They could have responded with something more aggressive. As well, a lot of the effect on the Chinese side is already offset by a currency weakening that is sort of already there. And then as recently as today, they're sending the message they don't want to see use devaluation as an additional policy from here for the currency. And that's a key signal for global markets as well.
And we had the CEO of Alibaba, Jack Ma, in an interview yesterday in China saying that they are already beginning to see some pain in their business from these tariffs. So as we've been talking about for weeks and months now, there is a lot of weakness coming through this system in China.
But also in a trade showdown, the producing side has more to lose than the consumer side,
exactly.
the current account surplus country. So perhaps heading towards the deal, maybe perhaps as well the sense that Trump is really going to get a pasting in this midterm election and might have to climb down from some of his positions on trade. We'll see. The interesting value we can extract from the situation, I think, or the interesting information value we can extract from the situation being that we have all these negative headlines and then a very positive market. And I think that says a lot. And there's some opportunity there, I would suggest, especially in FX. If risk appetite continues higher, there's more risk on currencies against potentially the dollar as well as the Japanese yen. So let's round out today with our economic calendar, where we've got today a bit busier calendar than we've had earlier this week. The UK CPI reported it's been coming in a little bit. I don't think the market is terribly reactive to this unless it's a really bad miss on the downside. We're all looking for Brexit headlines. And then the latest test of the emerging market theme and our local risk on theme here will be in the Brazil rate announcement. If they don't move as is expected, does the market nonetheless find this as a buying opportunity for the real? And then other bits and pieces, we have the ECB's Draghi out speaking. We should always pay attention there, although their guidance is on autopilot. Their policy is on autopilot. And then one of the rare New Zealand data points coming in. A lot of their data is quarterly, so the market likes to look at those for where to trade the Kiwi. That's it for today. We'll wrap it up there, and we'll be back tomorrow with another edition of the market, the morning call.